Justin, morning.
Morning.
Hello again. We're going to talk today about the distinction and the differences between a equity or a share sale versus a asset or a business sale. On a share sale, as we know, a selling shareholder is selling their shares in a company. That means they are selling the company and all that it has inside it, which might mean liabilities, which might mean all of their assets, etc., etc. The alternative is that the company itself, not the shareholder, the company itself sells some or all of its assets. So it might be machinery, might be goodwill, customer contracts. And in that case, the company is the recipient of the proceeds of sale. And so there may be various reasons why a buyer or a seller wants to do it one way or the other. Do you want to lead in and give us some of those reasons?
Yeah, well, there is. I mean, typically with the businesses we sell, they're in mostly equity sales, so the sale of the shares.
Yeah.
And I think as you kind of like sort of pointed towards, the tax treatment of the monies that are received is quite different. So if you're a shareholder, you own securities in a business, shares, ordinary stock or otherwise, then you're taxed at a certain rate when you sell those shares.
On your gain.
On your gain, exactly right. So if a company, and we always have to remember that, and forgive me, I'm not the lawyer in the room, but a company is a legal entity in its own.
It is.
It has an identity. And so if the company is selling its assets, it is selling the business.
It becomes the seller.
It becomes the seller, not you as the shareholder. So it's fundamentally quite different, and of course is that the tax treatment can be enormously different. I mean, if the business is selling part of its assets and continues as a going concern, it effectively makes a gain, and potentially that might be subject to corporation tax, for example. If it's not going to go on as a going concern, it may well be that business can be liquidated in a voluntary liquidation, but of course then the tax treatment is quite different to how you're selling the shares. So it needs quite a lot of thought, just purely from a tax point of view, to say why. But the reasons why. So we have to sort of look a little bit at the buyer's motivation as to why they might want to buy assets versus buying the shares. The important aspect is that if you buy the shares, the equity in a business, the buyer is acquiring the history of that business. So if a business has been trading for 50 years, it acquires that business entity, that legal entity, and it assumes all of its liabilities, potential liabilities, contingent liabilities for that business going back to day dot. So, there are businesses out there that trade that have issues in them. It could be customer issues, it could be product issues, warranty issues in its products. There could be HR issues, staff employee issues, and it could be tax issues, for example.
Yes.
And it could well be that a buyer, after it does its due diligence, pre or after, at some point in the process, says, listen, we like the business, the trade, but we don't like the liabilities or the potential liabilities that might come with that business. And there are businesses out there that have that. So in those scenarios, the buyer might say, listen, we want to buy the assets. And of course, it's a really important point, this, because if a buyer acquires the assets from a company, it can take the assets, and the assets are all the physical stuff that makes up the business, the goodwill, which is the brand, the trade name, and so on. Mm-hmm. It can take all of that, it can take all of the employees over, 2P them across, transfer the people over to the employment of the buyer. In other words, it can maintain the business. Yeah. It would have to be a different legal entity name, but it might have the brand name that it takes with it. But it can acquire the assets, but it leaves all of the potential large liabilities. And we're not talking about the accounting creditors and stuff like that, the accounts payable. It can leave all the liabilities behind with the company. So, for example, if there is a serious product recall issue, that the company may be liable for, by buying the assets, you leave that problem potentially behind.
Yeah.
If there's an employee issue, potentially you can buy the assets and leave that behind with the company. Of course, the shareholders still have to maintain that. So from a buyer's point of view, it's quite attractive in a sense, or can be attractive, to buy the assets of a business.
It can be neater, can't it? I think that if on due diligence you do uncover these legacy issues, shall we say, of things that perhaps are imperfect in the company's history, then sort of cherry picking those assets can make a lot of sense. I think that it's important to remember that from a buyer's perspective on an asset sale and purchase, there's a little bit more sort of administration and logistics. You've got to deal with assigning contracts from the selling entity over to the buyer. So customer contracts, can you assign them? Suppliers, will they deal with your new entity or will they only deal with the previous entity? It's quite interesting for consents and regulatory issues, because if your company is licensed, perhaps it supplies the aviation sector, perhaps it is a care home, those licenses to perform that work will be with the selling company. The buyer will need those licenses and consents to continue operating the business. Are they transferable? What's the time frame? What's the cost? So there are advantages to an asset sale. There are also, I think, some logistical challenges with it. The advantage of buying the company by buying the shares is you're buying a sort of ready-made package that, you know, off you go, don't have to worry about assigning contracts and all that sort of stuff. But as you say, it is a sort of warts and all scenario, which goes back to one of our previous videos, demonstrates the importance of doing good quality due diligence. Buying shares and buying company is fine, so long as you've actually got your eyes wide open, you've done a good due diligence exercise and you're actually fully aware of what you're buying. The danger is doing inadequate DD, buying a company and discovering the issues later. That's a position that neither the buyer nor the seller want to be in, really. Yeah,
I think that's right. And I think, you know, I think in a practical sense, there's two material drivers behind, let's say, an asset sale.
Yeah.
One is a carve-out. So if a business, and typically these are larger companies, they don't want to sell the entire business. They have an element of the business, and it could be a specific type of trade within that business.
Yeah.
Is they might say, listen, we don't want to sell the whole company. We might be turning over 100 million, and we've got 10 million trade line on this particular line of products or
trading
services,
division, yeah.
A trading division, or a trading brand name, for example, and we just simply want to carve that out. So
yes.
We're going to sell the assets, and that's a very common thing.
Yeah.
But the second element is where there is genuinely a material recognition somewhere between buyer or the seller that there's a material issue there. And I'll give an example. So a long time ago, there was a business that was, let's say, a mid-sized company, and all of the shareholders and management team invoiced their costs, their running costs, into the business via service companies, via multiple service companies, and more than 15, I think, of the management team stroke shareholders, who were all operational in the business, working doing an active job, invoicing their services via a service company. Now, I'm not a tax specialist, but it's certainly in the due diligence process, the buyer said, listen, potentially you might be in breach of IR35.
Yeah.
In other words, is that, you know, the inland revenue, or HMRC as it's now known, may have a legitimate claim that says you are actually employees and you should be on the payroll of this company. And of course, is that when the maths were done to saying, well, what is the potential claim if it was substantiated, for example? You know, it was over £1 million worth of potential liabilities. And of course, the buyer said, listen, you know, you as sellers have been running the business and you've been accepting the risk knowingly of what you're doing, which may or may not be in line with the rules. We don't know.
Yeah.
But what we can say is it's a question mark. You as sellers are comfortable with the risk, but we as buyers, we are not comfortable with that question mark. Now, that's one of those material sort of issues that triggers the point that says, well, why not sell us the assets and the goodwill and the trade? And we'll leave that potential IR35 claim back with you guys. And so it's either a carve out or there's an issue on the table that, you know, somebody knows about, and it just is something that the buyers are not willing to buy.
I think it's a good example, and I think that from a seller's perspective on that particular example, they're almost in no worse position because they were accepting the risk for so long as they were operating in that way, and once they've sold the business and the assets, then it's up to them to regularise or not, or deal with that situation with the revenue if needed. I can understand why a buyer would be nervous about taking that sort of risk on. But yeah, I mean, tax treatment is key. You've mentioned that. I think that you need a good accountant, a good CF advisor who can be looking at scenarios for you. Excuse me. If we sell the company, what's the tax treatment? What's my net gain? What's my tax treatment? If I sell the assets, same question. What am I going to end up with? So it's important to consider both methods for selling the company and to run some sort of forecasting of what's the net result for me in pounds and pence if I do it one way versus the other. So as is often the case, the lesson or the message here is probably get advice, speak to your nominated tax and accounting expert and work out what works for you and see what the buyer's prepared to do. Sometimes there's got to be a bit of a negotiation or a horse trade on these things, and both parties have got to be committed to doing the deal in the same way.
Yeah, that's good advice. So I think that's hopefully covered off the difference between an equity sale and an asset sale. So thank you, Nick.
Excellent, cheers.